On this episode of the Reynolds Direction, I'm joined by Don Schweiker to discuss financing in your real estate transaction. Well, Don, thank you very much for coming on the show today.
Thank you, Trevor, for having me. It was a wonderful opportunity to be here today.
So I want to start by giving you the chance to introduce yourself and the organization that you work for.
Sure. My name is Dawn Schweiker. I'm with Premier Mortgage Partners of Florida, and I have been in the mortgage industry for 25 years.
Okay. So you have definitely been, I've got to say, probably the most anticipated episode of the show.
Oh, wow.
I feel like all of the agents and even Scott has us be like, when are you going to bring Don on? Because mortgages and financing is definitely one of those big things that agents talk about all the time with their clients. And because you have such a breadth of expertise in the field, it'll definitely be good to kind of to go over some of the basics over financing and mortgages.
Absolutely. I'm so glad to be here.
So I want to start off by kind of going over the basics of how you come into play when the agents are talking to their clients and they're going over what their financing options are for buying a home. So whenever you get referred out a client from another agent, how do you usually go about going over the process for how a client can qualify for a loan?
So first, what I do is I have a quick conversation with the customer to determine how we're looking to structure this loan. Is it a primary residence? Is it a second home? And then they'll fill out their information online. And I'll go back and review it, and then we'll have a conversation based on their income, their assets, and what they're looking to do long term as to how we structure that loan program for them. Now, as a broker, I have the ability to shop the interest rate. What that means is that I have many different lenders that I use, that I can take a look at the programs to say, okay, maybe this lender's better with manufactured homes, or this lender's better with condominiums. So I have the ability to not only shop the rates, but also shop the process. So if I have a lender, like I said, it's better with one, then I'll use that lender instead of maybe another lender. Whereas individual banks, they have one set of lenders, one set of guidelines, and that's what they go by.
Interesting. So it almost sounds as if there's a different way in which you can shop around for different financing products for customers.
That's absolutely correct.
Okay. And I'm sure that there's a number of different aspects as far as breaking down a client's finances, all their information. And one of the big things that I hear spread around the office and that's specifically discussed is credit scores. So how exactly, in just a basic synopsis, do credit scores play into getting qualified for a loan?
That's a great question. Credit scores are very important. It determines not only the loan program, but the interest rate. So, for instance, with a borrower that has 700-800 credit scores, they pretty much have the ability to do whatever type of loan they want. They can do conventional, FHA, VA, whatever. If we have a borrower that has less than 620 credit scores, then their loan products are a little bit limited. Then it's either a VA loan, a USDA loan, or VA loan, or an FHA loan. Those loans do have the ability to go down below that 620 credit score. So that's something that we discuss as well when we're looking for a buyer to get qualified.
So it sounds as though the credit score dictates not only the product, but also the interest rate that they're set at.
That's absolutely correct.
Okay.
Borrowers with a lower credit score, because of the credit considered a credit risk, would have a little bit higher of an interest rate.
Okay. And so kind of going over, I know you just mentioned some of them. What exact mortgage options are typically available, or the most popular ones that you decide to write up for clients?
Yeah, there are over 300 mortgage programs. So there is a wide array of different options that a borrower would have. The most popular, however, are going to be your FHA, your VA, and your conventional. Conventional loans do have a loan limit. And as of January 1st, that loan limit has been increased to $647,200, which means that if a borrower is wanting to borrow under that amount or less, then they can go into regular conventional, which is your Fannie Mae and your Freddie Mac programs. FHA has a loan limit based on the county that the property is located in. So that would depend on where the property is, and VA, they've actually removed their loan limits, so you can get a VA loan without having to put any money down, and it can go up to $1 million or so, whatever the borrower qualifies for.
Okay, that's definitely an interesting point. It definitely sounds like the rate at which you get in the product is actually pretty local to the area and the specific address almost that you're looking at in terms of financing.
That's correct. So here in Vero Beach and on the beach communities in Florida, the property prices are much higher than inland and in other areas. So that very popular loan program for those properties would be what's called a jumbo mortgage. So a jumbo mortgage is different set of guidelines. It's not backed by Fannie Mae or Freddie Mac. It's a loan that a specific lender would retain, and that is any loan amount over that conforming limit of $647,200.
Okay. Well, definitely all good points to know. And you started to mention as far as how credit score can affect the interest rates for the mortgage loan you get. What other kind of factors really kind of go into the exact interest rate that's set in a loan? There are many different factors that go into an interest rate. Sometimes you'll see an advertisement that says the interest rate is 3.125, but somewhere on that advertisement you're going to see in the very small print that rate is based off of several different factors. So it would be based off of a credit score, a loan amount, down payment percentage, how much down payment is being placed, and property type. Properties that are condominiums, for instance, they have a different, what the lender considers as a layer of risk. So those interest rates may be slightly higher than a single family home, for instance, depending on down payment and other factors. So all of those things go into determining an interest rate. Interesting. So definitely the type of home you're looking at affects it, along with all the other different specifics regarding communities, HOAs, and taxes, and all the sorts of other aspects of it.
That's correct.
And I know definitely one of the biggest parts of how the market has just kind of exploded in the past year is because money is so cheap right now. And because interest rates are set so low, people are realizing that they can acquire the cash that they would need for a home purchase quicker and in the moment with lower interest rates. So even with that in mind, how much do you think that people should generally have set aside for a down payment in a typical loan?
Typically, it's going to depend on what type of program the buyer is looking for. If the buyer is a veteran or active military, they actually don't need a down payment. They can go in with 100% financing, no money down. There's another program that borrowers can take advantage of if the property is located in a rural area, as determined by the U.S. Department of Agriculture. So if the property's deemed in a rural area, that's another program that a borrower can, if they qualify, can do zero down. Now, besides the down payment, there's also closing costs, but we'll get to that in a second. On the down payment, if the buyer is looking to do an FHA loan, for instance, then the minimum down payment's 3.5%. Conventional actually has a 3% down program for borrowers who qualify, which would be a first-time home buyer, or a borrower, which a first-time home buyer is someone who hasn't owned a home in the last 3 years, or a borrower that is in a certain income level. If they are in the area that they are living in or buying in, actually, if the area median income, if they're 80% of that area median income, then they can also qualify for that 3% down payment program. So there are very, very many different options for down payment and how much a borrower should save. But in addition to the down payment, you also have closing costs. Mm-hmm. Closing costs are going to be your title insurance, your survey, your appraisal fee, any application fees, tax stamps to the state of Florida, as well as you have to pay your first year of homeowner's insurance up front and money into your escrow account for the bills that come due when they do come due. So on average, let's say if you have a house that's around $300,000, then you'll need approximately between $7,000 and $10,000 for closing costs. Higher priced properties will obviously be more more closing costs. But you can ask the seller to help participate and give you money towards your closing costs. So what you could do is you can build that into your negotiations with the seller.
Yeah, and I think that's definitely something that can often get overlooked is closing costs, and definitely having the financing set aside just to make sure that that under contract process too is less stressful than it needs to be is also something very good to keep in mind.
Yes, yes. So when you're getting pre-qualified, this is definitely things that you need to ask your loan officer that you're working with, is not only how much do you need for down payment, but how much are you expected to need for closing costs? Because we could look to structure certain things to assist you with that. If the seller is unwilling to participate and give you some funds for closing, sometimes the lender can, if for a little bit higher of an interest rate, can give you a credit. So those are things that we can look to do to structure your transaction properly. And I recommend before you even begin negotiating on a property that you have this discussion with your loan officer, so that way when you do go under contract, you're not unpleasantly surprised by the amount that you're going to need or what those payments would be.
Yeah, absolutely. I think that's all very good advice. And I know that definitely from the conversations I've heard you go over with clients and what the agents have discussed as far as kind of planning out the monthly mortgage payments, there's a lot of different things that people can include in their overall financing that gets factored into the monthly payments you make on the mortgage. So what all do you kind of see can be generally included in the payment besides the main points such as the interest on the loan?
The main components of a mortgage payment are going to be the principal and interest, the repayment of the loan plus the interest. Then you also will have your homeowner's insurance, your property taxes, and if the loan has mortgage insurance. Now, for FHA loans, you're required to have mortgage insurance for the entire life of the loan. So, and you'll have that mortgage insurance premium. For conventional loans, if you put less than 20% down, then you're going to be required to carry mortgage insurance. There's a couple of different ways to do mortgage insurance on conventional loans. You can pay a premium up front and eliminate it altogether, or you can pay it monthly. And most people do it monthly because when you pay it up front, you're also taking a higher interest rate. So it depends on your credit scores and your criteria. We could always analyze that, but that will be part of your monthly mortgage payment. Now, you also have association fees. It's something that what we do when we calculate our loan payment, we don't include, when you make your mortgage payment, that is, association fees aren't part of your payment, but you will have that on a monthly basis. So we should keep that in mind when you're doing your budget.
Absolutely. And I think one of the other biggest things that I've heard of people doing is when they come into a little bit of extra money during the lifetime of the loan, what is sort of the structure with making bigger payments than or go above and beyond the monthly mortgage payment? Are you just allowed to dump money at any time, or do you give the loan officer a warning that you're adding more funds to the loan, or how does that process work if people want to go above and beyond at different points in the loan?
They absolutely can. There are no prepayment penalties with loans in Florida unless you're doing some kind of special type of loan program that's not standard. Okay, so on a standard mortgage in Florida, prepayment penalties are not permitted. So you can pay it down as much as you want when you want. The only thing is that it will not change your monthly mortgage payment. You can place, $5,000 down, $10,000 down. Your payment's still going to be the same, but you'll just pay the loan off sooner. I highly recommend rounding up. Like when you make your mortgage payment, if your mortgage payment is $1,420, round it up to $1,500. That extra $80 a month is probably not going to break your bank, but it helps accelerate the mortgage to get it paid off sooner. And the sooner you pay it off, the less interest you pay. So you only pay on the principal balance. Your interest is only calculated on the principal balance of the loan. As you pay that principal balance down, it's less interest that you'll pay on your mortgage as well.
All right. And there's excuse me, there's one term that you brought up earlier that I feel like I've also heard thrown a lot around in this business, and that is an escrow account. And definitely when it comes to the under contract process and the financing process, the escrow account becomes a very big point of kind of getting money back and forth between where it needs to go. So can you kind of break down what exactly an escrow account is and what it's used for?
Sure. There's a couple different escrow accounts when you're dealing with a mortgage transaction, you're buying a home. The title company, you'll need to place an amount in escrow upfront to hold the contract. So in other words, when you go under contract on a house, the seller is going to want to see that you have some skin in the game. So they're going to want you to place money into an escrow account. That's one type of escrow account. Your mortgage will also have its own escrow account, and that escrow account is for your property taxes, your homeowner's insurance, and if there's any mortgage insurance. So what it does is we take 1/12 of the premium of your homeowner's insurance and 1/12 of your property taxes, and we place that add that actually to your principal and interest, okay, as well as the PMI. So when you make your payment, you're going to make one payment that includes the principal, the interest, the property taxes, the homeowner's insurance, and the mortgage insurance. And when you make your payment, the lender will take the money that's needed that was collected for the escrow account, for the taxes and insurance, and they take that money and they set it aside in a separate account. And when the bills come due, whether it's the mortgage insurance every month or whether it's the property taxes and homeowners every year, then they'll go into that account, they'll take the funds for that, and they'll make those payments. Now, taxes in in Florida are due November 1st. So when we receive the tax bill, the lender will analyze the escrow account and determine whether they need to make any changes. If the taxes have gone up, then we need to change your mortgage payment accordingly. If your homeowner's insurance goes up, then same thing, they need to make changes. Sometimes it'll go up and you'll be short, so they would have paid it for you, but you really wouldn't have had enough in that escrow account. So they will send you a notice to say, okay, your escrow account is short, and we need to collect either X amount of dollars that you can pay in a lump sum, or you can take that, if you choose, you could take that shortage and spread it out over the next 12 months so that you don't have to come up with that extra money.
Okay, so it essentially is a way for the bank to kind of directly have that money accessible when big payments like those come up, so that the buyer and the person who's taking on the mortgage has already put in those funds in to give that bank that sort of insurance. Correct, because they need to make sure, especially property taxes, because property taxes are a lien can be a lien on the property. If you don't pay the property taxes, a lien gets placed on the property, and that lien supersedes the mortgage. So the lenders want to make sure, and mortgage companies want to make sure that there's funds and those accounts are being paid. Now, you can waive your escrow account. If you put 20% down or more, you can elect to pay your own property taxes and insurance. Sometimes some lenders do charge a fee, like a one-time fee at closing, which equates to about 1/4% that they will collect, and they will let you pay your own property taxes and insurance. They still have to monitor to make sure that they've been paid, because if they do lapse, so they're still going to request copies of your insurance to make sure that it's still active, because if there's a fire or anything like that and the house is damaged, or they need to make sure their collateral is protected. So they're still going to want evidence that you're making these payments instead of them making the payments. But that's an option that you can do if you choose to pay those bills on your own. Okay. Well, it definitely seems as though you have a wealth of knowledge in this area, and it's definitely good to have someone like you on the show to kind of go over the specifics of it, because it is such a big part of people's transaction.
Yes, most people do obtain financing. So these are many factors and questions that a lot of my customers have is how do these, how does this work, and how does it work on the long term, and things like that. So I'm really glad that I was that you had invited me to come onto the show today.
Absolutely. And just one final question I thought of is, I feel like a lot of people my age, kind of in their 20s, maybe early 30s, are kind of looking at the forecast of buying a home down the line, or when they start a family, wanting to get more space. And a lot of them seem to be kind of down on their chances of it, but and kind of like reflecting on like the younger generations coming up and looking at the financing options available, what would you advise younger people who are looking at eventually owning a home in, say, the next 5 to 10 years in terms of looking at their financing options?
I think now's the best time. Hindsight's 2020. So if you don't look to purchase a home and for another 10 years, then you're going to look back and say, darn, I really wish I did this in my 20s. I could have had all this equity built up, and then I could buy the house of my dreams. My husband and I, we've been married for 30 years. We bought our first home when we were 20. And we just did the American dream of take the equity, we buy and move up. So the sooner you start, and I understand that the initial upfront costs as far as saving for down payment and closing costs can be a little overwhelming. It's a lot of money. But there are many different options. Family members can gift. Mom and dad can help you with the down payment, or, if you have relatives, or there's a lot of different things that we can do. And my recommendation for someone in their 20s and 30s is talk to a loan officer and just get an idea and set a game plan. Just set a path to say, okay, by time I reach 25, I need to save this much money in order to buy a house, or just to create a roadmap, because time goes by fast.
It does indeed. Well, Dawn, thank you very much for coming on the show and sharing your knowledge with us. This has been a great episode.
Thank you, and have a great day, and thank you so much for having me.
Absolutely. And stay tuned for more episodes of The Reynolds Direction.